they would point us again to the 70s. This is the last time that this metric based in this way, and the resolution was very negative. It was highly inflationary environment, big deficits, both trade and government, and many fear that that's what we are going to face. So the uptrend of Bitcoin relative to gold, despite recent performance, has not been broken, at least not yet. We're very bullish on Bitcoin, as you know, longer term, but gold is very recently has given it a bit of competition. We think they are both plays, if that's what investors or speculators are betting on here, on the debasement of fiat currencies. And we think that both of them ultimately are going to rein in the monetary policies that have been unhinged for the last 50 years.
Cathie begins by dissecting the so-called collapse of the U.S. dollar that made headlines earlier this year. Most analysts focused on the DXY index, which measures the dollar against just 6 major currencies, mainly the euro, yen, and pound. That narrow lens showed a sharp drop, leading to alarming headlines that this was the worst first half for the dollar since 1973, but Cathie argues that this is misleading. The trade-weighted dollar, which measures the currency against 26 countries, a much broader and more accurate view, tells a completely different story.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Here's the dollar. I know I featured DXY, which is against 6 countries, and that has been weak. This one is the one to keep our eye on, especially given the way the Fed thinks about things. This is against 26 countries, again, trade-weighted. And here you do not see the collapse in the dollar that was making headlines. Worst first half of the year since 1973, which on the DXY was true, not on this metric. So again, better to have a more complete picture than an exaggeration based on a narrow sample. Here you can see the S&P 500 earnings per share expectations for the next 12 months. And you can see they continue to go up. Part of that is the dollar. It has helped our multinationals in terms of in terms of their revenue and profit dynamics. But we also do believe that corporations are working diligently to increase their productivity. Already during a rolling recession, that is when innovation gains traction. When consumers and businesses are afraid of the future, they change the way they do things. And we think that is happening now to the benefit of innovation. Here are some of the market indicators that strategists have focused us on. So negative strategists have focused us on the S&P relative to gold. Gold has been going up, and you can see recently it has been going up relative to the S&P. And they would point us again to the 70s. This is the last time that this metric based in this way. And the resolution was very negative. It was a highly inflationary environment, big deficits, both trade and government, and many fear that that's what we are going to face. We do not agree with that. One of the reasons we don't agree with that is on the next chart. This tends to be a leading indicator. This is the S&P to crude oil, and the S&P is going up relative to crude oil. You can see in the 70s what happened to this one. It based and then collapsed. So this would say all clear. And here is the 10-year Treasury yield. Again, is it levitating because of governments and foreign investors pulling out of the U.S.? Perhaps. But if truth does win out, we think that these long rates will come back in a bit, at least until next year, when it is clear, if we're right, we're in a very strong expansion. So the uptrend of Bitcoin relative to gold, despite recent performance, has not been broken, at least not yet. We're very bullish on Bitcoin, as you know, longer term. But gold is very recently has given it a bit of competition. We think they are both plays, if that's what investors or speculators are betting on here, on the debasement of fiat currencies. And we think that both of them ultimately are going to rein in the monetary policies that have been unhinged for the last 50 years. But that will take time. Anyway, that's it. I know this was long, but I think as I've gone around the world in these last 5 weeks, and I mean around the world, I've gotten a real sense of, how much pessimism there is about the United States. And being an insider, not an insider in terms of the administration, but just really watching policies and analyzing them instead of reading headlines, I can tell you, I think the surprises are going to be on the high side of expectations in terms of activity and on the low side of expectations in terms of inflation during the next few years. Commodity prices, flat, you can say, for the last 45 years. I know there's a lot of volatility, but recently not so much volatility, which is very interesting, given the volatile policy metrics out there, measures. This is our metals to gold ratio, so metals price to gold price. I continue to believe that somewhere in the world, something is not right. And we've been saying we think it's China. We think the deflationary bust there is worse than the government is reporting. That could be wrong, but we can't figure this one out. The gold price has been very strong, and it has been, many people are calling it the debasement trade. Both gold and Bitcoin have been strong on balance. Gold recently much stronger than Bitcoin. So there's definitely fear of something out there.
Cathie also unpacks recent U.S. data revisions that reveal the economy may be weaker than reported. Earlier this year, employment figures were revised downward by over 900,000 jobs, exposing cracks in the labor market. The private ADP report also showed job losses, and even government employment is declining, with an estimated 150,000 more federal jobs potentially being cut by year-end. Meanwhile, inflation remains sticky due to tariffs, which push input costs higher even as demand softens.
Maybe it's not the deflationary bust in China, although I still look at 40% investment relative to GDP in China as way too high. Sure, they're building 28 nuclear plants, but 40% of GDP, that is not. There is a lot of other investment going on in China, which might be exacerbating the deflationary bust in property that they're experiencing. But then again, in terms of gold prices going up, I mean, our policies are bringing about some of that. The geopolitical risks, tariffs, the visa program that was announced this month. A lot of people are saying, I can't figure this out. And as I said, I've been around the world in the last 5 weeks, and I think a lot of people are very negative on the U.S., and I've just given you a bunch of reasons why we are not. But I do understand why they're negative, because the headlines are so stark, and they're not picking up what's going on underneath. I think President Trump is a maestro at distracting with a lot of drama and then getting the job done. That happened in his first administration, and I think it's happening in this administration as well. Nonetheless, people are saying, I'm going to lower my exposure to the U.S. Gold is my hedge. It's an insurance policy, and so forth. And it may be why our interest rates have not come down, for the same reason. Governments and individuals abroad lowering their exposure to the U.S. Now, I think that will reverse, again, for reasons I suggested, but I do understand why we're seeing what we're seeing. And this is a very new report. It just came out today. Here you can see the ISM for services, so non-manufacturing, but a broader take at it, dropped back to 50. And I should have explained, 50 is the demarcation point between expansion and contraction. So ISM for services, the new orders, which is in green, slipped back to 50, meaning there's really no growth. You can see prices paid around that 70 mark. So those prices are still going up. But notice what I just said. Activity down, prices up. Companies try and make up for weak activity with pricing, especially as they're facing tariffs. And a lot of the manufacturers who report in this survey mentioned tariffs, that the tariff cost increases have intensified, and they're trying to get those costs passed through into pricing. And we'll see if they are successful. One of the reasons orders have relapsed, we believe, is because they are trying to get prices through. And the consumers of these products are basically saying, no, you'll have to cut your prices. So again, stay tuned on that one. And it's important because this is the services sector. It is very interesting to know that the stock market usually goes up while the government is shut for whatever reason. Anyway, we do have a lot of statistics to discuss. I think since the last In the Know, we got the huge revision in employment. It was 911,000 jobs fewer in March 25 than had been originally reported. So we had been showing you consistently monthly revisions, which were down. And of course, the total was almost 1 million. The Fed did cut the Fed funds rate by 25 basis points. They are still balancing between inflation, which once again seems stuck because tariffs are working through, so stuck in the 2.5% to 3% range for the most part, against employment, which is beginning to deteriorate. We did get this week the ADP payroll report. This is from the private sector, and the number there was negative 32, and perhaps more important, the previous month was revised down from plus 52 to minus 3,000. That's unusual in the ADP survey. So employment is weakening, and probably more significantly than we understand. There are a couple of reasons here. One, of course, is cyclical. Employment is a lagging indicator. We've been talking about a rolling recession for the past 3 years, and we've started moving past that in terms of at least our understanding of what is unfolding, into the thought that we may be going into a rolling recovery, which we think next year will evolve into a productivity-driven boom in activity, just in time for the midterm campaign election season. I don't think that is a coincidence. I think the Trump administration has taken or given a lot of tough medicine very early in its term, and that it is looking forward to a very exciting next 3 years. But the Fed is grappling here. Employment down, inflation sticky. And so we're once again in that are they or are they not going to cut rates again? We think they will. And one of the other reasons is not only is private employment falling, but we know government employment is falling. And we believe between now and the end of the year, another 150,000 jobs will be lost in the federal sector. And it could be even more than that, because with this shutdown, it seems like the administration is doing more, I think, what it would call house cleaning, to increase the efficiency of government and get spending under control.
Companies are trying to pass these costs on, but consumers are pushing back, leading to weak new orders in the services sector. Cathie believes the Fed will cut rates again despite public hesitation. The central bank is balancing deteriorating employment against modest inflation, a tough combination that historically leads to easing. In her view, these moves will help stabilize the economy ahead of the 2026 election cycle, setting the stage for a productivity-driven expansion just as political momentum builds.